Welcome to Invested in Climate. Protecting the planet and decarbonizing the global economy is the challenge of our time. We all have a role to play, and the opportunity we face is unprecedented. Invested in Climate aims to help people do more to address climate change through their work, investments, lifestyle, and activism. I'm your host, Jason Rissman. I support a growing community of top climate and ESG leaders as the Chief Experience Officer at NationsWell, and I'm an advisor to the climate practice at IDEO. I'm also an investor and startup advisor, and when it comes to climate action, I know I'll be a lifelong learner, always looking to have more impact. If you like what you hear, give us a good rating on Apple, Spotify, or wherever you found us. Sign up for updates and suggest ideas for future episodes at investedinclimate.com. Follow us on social, subscribe, and spread the word. Thanks for joining.
The economics actually reflect a case for climate investing. And that's sort of aside from all of the politics and the sentiment and the ESG and the branding, that's not an economic reason to invest. So what we think is that once everything starts to normalize a little bit, that we will begin to see mid-teens performance. And right now, valuations are incredibly attractive. And so this to us is an excellent entry point.
Hey everyone, if you believe the climate transition is creating trillions of dollars of opportunity, then backing public companies whose business models are centered on that transition and whose growth will be driven by it seems an almost obvious approach. That's exactly what Heather Beatty and ScopeFour Capital are doing, and I was excited to hear what they're learning and the opportunities they see. In this conversation, we talk about Heather's background and how she came to found ScopeFour after decades in institutional investing. We talk about their approach, their portfolio, and the opportunities they're most excited about. We also talk about the election, how it's influencing their investing in the short term and the potential long-term implications. We talk about green hushing and the resilience of corporate climate action, and much more. Lots to think about in this one. Here we go. Hey, Heather, welcome to Invested in Climate.
Thanks for having me, Jason.
So glad to have you here and be in conversation with you today. Where do I find you today?
Today, I'm in Los Angeles, which is where we're headquartered.
Fantastic. Well, before we dive into your work at ScopeFour, let's learn a bit about you. Tell us about your background, and even before you knew exactly what you wanted to do, how did you become interested in working on climate?
I have a pretty traditional background historically. I've been in the institutional investment world for the last 20 years or so. And about 5 years ago, from a professional standpoint, a lot of our clients, institutional clients, started asking us about how we were thinking about the energy transition, both from a risk standpoint and then from a return standpoint as well. And the company that I was working for at the time, First Eagle, had just started implementing ESG, but we're having a tough time separating, okay, what does it mean for a company to have an environmental footprint versus what does it mean to be talking about climate risk in a portfolio? And what are the actual opportunities for decarbonization? And that began to lead me down a path where I worked closely with the investment team, and I launched the Climate Council there to figure out how we wanted to approach climate, both operationally and from an investment standpoint. That's professionally how I got into climate. And then personally is a little bit of a different story in that I believe in ikigai, which is just a Japanese term for continuous growth.
Yeah, I love ikigai.
Yeah. And I'm an avid traveler. I love to read, and I find myself reading all kinds of random things about like bees. And I'll just pick up a book at a bookstore when I'm traveling. I read a ton of books, one starting with Sapiens, which I always quote by Yuval Harari. I don't know. Have you ever read it?
Absolutely.
It's just about humanity and its history and basically where we're going. And I also read a book called The Sixth Extinction, which is about the extinction of animals in today's world. And I read a book called Garbology, which is all about the history of trash. And I did that.
These are heavy reads, Heather.
I know.
Not your beach reading.
Not beach reading. That's true. I do like to travel to some interesting places like Cambodia, and I've been to Vietnam and India. And so as you're reading about garbage and then you're looking outside and you're seeing this waste management issue and you're reading about pollution in the ocean, and then you're looking outside and you're seeing people kind of toss things in the ocean, it becomes very visceral and real. it impacted me, all of my travels in such a deep way. And I feel that all of these things ultimately are what have led to what we call climate change today. It's not just about weather patterns, right? It's about supply chain and how are we getting the things that we're consuming. And that all kind of dovetailed with my professional work. And it made me feel like this was the path that I wanted to take as part of my purpose as a human being. And I also felt that this is one of the greatest economic opportunities that we're going to face in this lifetime as we completely rewire infrastructure to address this.
Well, Heather, I find your story really inspiring. You're working in finance, you have a growing understanding and concern around climate. You start integrating climate into your job. Connect the dots to how that led to you to founding ScopeFour.
I do believe strongly that in the investment world, we're not that focused on science and what it actually is going to take from a science perspective to get to where we want to go to meet our goals. So I actually decided to get an executive master's degree from Duke in environmental management because I really wanted to, I had the investment piece down and then learn about how can we allocate capital in a way that's actually going to help solve our problems. And so completed that and then actually came across an organization called Project Drawdown. Are you familiar with them?
Absolutely. Jamie Beck Alexander from Project Drawdown was actually one of my first guests on the podcast a couple of years ago.
Oh, yes.
And I actually worked briefly with Jamie while I was at IDEO.
So I love Jamie, and I established a relationship with their executive director, Jonathan Foley. And for those who are listening and haven't come across Project Drawdown, I would highly recommend it because when we talk about climate action or climate solutions, it can often feel really nebulous. It's like, what exactly? I have no idea. What are we actually talking about? And they created actually kind of a coffee table book, but really it's a science-based organization that uses science to identify how to implement climate solutions across geographies and timescales and sectors, and really breaks down the top 100 solutions that, if scaled, would just solve the problem. And so I was thinking, why aren't we investing in this way, right? If we're going to work to solve this problem, we need obviously policy, we need education, and then we need investment. And why aren't we applying and following this mechanism? And especially in public markets, which is what we do, and we can talk about that, I felt that we weren't investing in the alpha opportunity. And so Project Drawdown inspired me to launch ScopeFour Capital. And that was about 2 years ago.
Heather, before we go into learning more about what ScopeFour is and how you're running the fund, I think you prompted us with a question that I'd love to go deeper into, which is, why aren't we investing in this way? Why aren't we following science and following recommendations from research like Project Drawdown? And why is it that the financial markets aren't quicker to adapt to the real needs and really the real opportunities that societies and markets face?
That's the question of the day, Jason. I don't know 100% the answer to that. I would start by saying that it's still a nascent way of thinking about how to invest. I mean, when I was working with the portfolio managers at First Eagle, no one has really a background, for example, in science or thinking about climate investing. And the CFA just recently came out with a program that actually our portfolio manager, Robin, is in the first cohort for. But prior to that, there wasn't really a vernacular for thinking about it. And also, I would say that technology has been evolving. Today, we now have about 2/3 of the technology that we need to solve this problem. But that's also come pretty swiftly. And there also needs to be economies of scale for some of the solutions that we need to implement. So some of them, and this is really the whole point, some of them are really economically viable and they are investment opportunities. And then some of them are really more on the philanthropic side. So for example, peatland rewetting I always use, or grassland protection. That's not an externality that we've identified as a society that has a great economic value. And that's something that we're still trying to solve for. I just think that it's an intersectional problem that requires a multitude of different types of expertise. And I think we are actually making really great progress, but just not at the speed that we need to.
Okay, well, thank you for going off course with me and venturing into something more philosophical, but always good to think about the big picture. Let's hear more about ScopeFour. Tell us about your company and what is it you're aiming to do?
We create investment portfolios that invest in public companies that are scaling climate solutions. And I alluded to this before, but I think of solving climate as a continuum. And you can allocate capital. Let's just say you have $100. You could allocate capital philanthropically to climate solutions. You can invest in innovation right now, like carbon capture and storage, or kelp is an algae, a huge climate solution in the blue economy that VC companies and innovators are looking at. And then there's also the public markets. And really, that to me is where you take economically viable and currently impactful climate solutions, and you're able to scale them in a way that's meaningful and create emission reduction. So that's why we're focused on public markets. So all of our portfolios take a global view, and we've created actually a taxonomy that looks at all of the climate solutions that we think are economically viable. And we've created actually a proprietary universe around that as a starting point for our idea generation. Because if you just think about all of the indices out there today, the MSCI All Country World and the S&P 500 wasn't built with climate in mind, right? And so really, again, you asked me why aren't we investing in this way? It's because financial markets haven't caught up to the actual opportunity and aren't incorporating it in the way that we think about sectors and countries. GIC sectors, for example, aren't thinking about climate solutions. And so I think that's still evolving.
Heather, there's lots of ways that folks are trying to invest in climate right now. And I think really interesting to understand why your approach is different and what's unique about ScopeFour. Some folks might hear what you described and say, hey, that sounds like an ESG fund. But I think you're doing something a bit different.
So we invest specifically in climate mitigation and adaptation. So if you think about an ESG fund, it invests in, first of all, takes environment and social and governance into consideration, and it applies it generally as a metric. And you can apply it to any company out there. On the flip side, if you just think about the demand for decarbonization or the commitments to net zero, there are actually over 140 countries that have now committed to net zero, and over 4,700 public companies that have net zero commitments. And we just actually reached a record in terms of companies that have now a science-based target for their commitments. And so that to me represents demand for lowering emissions. We invest in companies that represent supply. So we're looking at companies that have a climate solution as a material part of its business model based on revenues. For example, I'll just give you a really basic example of a climate solution, which can be utility scale solar or onshore wind. There are also climate solutions that one doesn't normally think about. For example, if you think about building energy efficiency, buildings actually make up a huge part of where emissions are coming from. And so implementing things like heat pumps or insulation or smart glass or building automation systems, those are all climate solutions that companies are scaling as a result of a variety of different things. And those are also the types of things that we invest in. So it actually looks nothing like the S&P 500. It looks nothing like an ESG fund. We don't invest in things like NVIDIA or Microsoft or Apple because their business model isn't actually trying to reduce emissions through its goods and services. So it ends up being very much an uncorrelated exposure to what we consider to be a multi-decade secular trend.
Fantastic. Well, I love the approach, but of course, there's naysayers, and there's naysayers of climate investing who might point to recent performance of some kinds of green investing and say, the market's just not there currently. What do you say to them?
So I think, first of all, right now, the numbers are being compared to a benchmark. Let's just call it the S&P 500 or the ACWI, that, in my view, is the riskiest it's ever been from a concentration standpoint. So just think about it. There are 3 stocks that make up a huge percentage of the S&P 500 today. And that's not really normal in any market environment. So kind of taking that into consideration, even with the drawdown in climate stocks, the companies and the earnings in our portfolio are actually still posting mid to high single digit returns, just depending on the moment. So I think even with all the bad news, it's still pretty good at the end of the day. I think capital markets aren't supposed to do 25% a year, right? A normal market is 8 to 10% a year. And our portfolio is doing 14% in earnings growth. And so that's in aggregate. So I think that the economics actually reflect a case for climate investing. And that's sort of aside from all of the politics and the sentiment and the ESG and the branding. That's not an economic reason to invest. So what we think is that once everything starts to normalize a little bit, that we will begin to see mid-teens performance. And right now, valuations are incredibly attractive. And so this to us is an excellent entry point.
Thanks, Heather. Can you share some specific examples of investments you've made? You've talked a little bit in broad sketches, but would love to dive into specifics.
Yeah, actually, today, Enphase is one of the top performing stocks in the S&P, and it's one of our top 10 holdings. So Enphase is actually headquartered here in California, and it manufactures solar microinverters and battery energy storage and EV charging stations. So some of the things that we were just talking about, and their earnings on battery storage just came in incredibly high. And so we're actually seeing early signs of stabilization in the solar space as well. You may be aware that particularly residential solar has not done well this year. And so sales and installation actually rose this quarter. So that's really a positive green shoot that we're seeing. So that's one example. Another example, we own ABB and Nexans in the portfolio, and they both are exposed to the grid theme. So upgrading of the grid globally is a huge theme, not only in our portfolio, but it's incredibly critical to solving for climate change and climate solutions. Nexans is actually a cable company out of France. So it's done really well just recently. And then just given the fast growth of data centers, we think that the unexpected incremental increase in demand is going to also be a huge catalyst for us in both ABB and Nexans, and any company that's basically tied to grid through increased demand of electrification.
Heather, you're scanning the market looking for public companies that have the most potential impact for climate and the best possible returns for your investors. And it leaves me really curious about, what are you hoping to see? What are the spaces and kinds of opportunities that excite you the most right now?
So at the end of the day, we're really focused on the picks and shovels of what I call decarbonization. And you just hit the nail on the head. Those are definitely three themes that we're excited about. Particularly utility scale solar and onshore wind kind of got hit earlier in the year alongside residential solar and offshore wind, but they have really different business models. And so we took an opportunity to buy into some of those really high quality names. We're actually also looking at water management and water treatment because there's a huge focus on water scarcity. And that's something that we could probably go into for another hour or so, just in terms of the demand for water and potable water in the world and how water is tied to industrials and also agriculture. So we're just focused on water as well in terms of the management and treatment and companies that are tied to that. And so we have quite a bit of exposure there.
Heather, your firm published a report earlier in this year called Leveraging Public Markets for Climate Impact. And it argues that public companies are needed to scale climate tech, and also that they have the financial flexibility to invest in R&D. In a recent episode, I actually heard a prominent venture investor complain about the unwillingness of public companies to actually invest in new and transitional technology. The average tenure of corporate CEOs is often way shorter than the payback period for some of these investments. So what do you say to this criticism, and what can be done to encourage faster adoption of climate tech that needs to reach scale?
I think that's a good question. To me, that's really about whether or not executive compensation is tied to climate goals and initiatives. And that's something that we do look at. So, for example, there are some companies in our portfolio like Schneider and ABB and Iberdrola, where executive compensation is tied to their climate goals. And as a result, you are seeing what you might call green revenues exponentially grow with these three companies. So I think your question is more of a United States, US corporate CEO sentiment. And to me, there needs to be an improvement on governance where CEOs are incentivized over the long term rather than short term. So if you think about the United States, what they're doing is spinning off their green energy divisions instead of investing in R&D in companies. And you can think of a couple of examples of that just recently, like Veralto, which spin off of Danaher. So we're interested in companies that are transforming into climate companies. And an example of that is Hitachi in our portfolio. You're probably familiar with Hitachi, but you probably don't think of it as a climate company, right?
Yeah, for sure.
So that's a Japanese company. The CEO is relatively new and he came from their green division, and they actually have $8 billion in R&D dedicated to climate solutions in things like train electrification and wind blade recycling and drone afforestation. I do think that outside of the United States, there's a lot more R&D dedicated to some of these things. I mentioned ABB before as one of our grid infrastructure players. They also have a very strong R&D program, and they're also looking to transform their company. That's my 2 cents on it. I don't know if you agree or disagree. I think that there does need to be faster adoption, but that in some other countries, there's just a different view on how to go about doing that.
Yeah, well, I think it does go back to that incentive alignment for executives and making sure that they can think long term and not be only rewarded for short term.
Yeah, I agree with that.
So, Heather, as you think about investment opportunities, you're considering both the ROI and also climate impact. Is this a trade off, or do you see emissions reductions being really directly tied to the size of an opportunity?
So, just going back to what we talked about a moment ago, I first think that the climate solution needs to be economically viable first. And that's something that we really focus on. From there, emission reductions, we think are not separate from the size of opportunity. And that's the whole reason that we came into existence, is to actually tie the size of the opportunity and the ROI to the emission reduction piece. If you just think about it, you would ask, okay, why are we not allocating capital to this space faster? Why aren't we focused on the solution? I think that to attract investors, you need a high ROI in the first place, unless you have a subsidy, right? And if the subsidy goes away, then the company is no longer profitable and it's going to go under. And so at the end of the day, that's what we're doing. We are looking at where are emissions coming from? Are they coming from mining? Are they coming from transportation? Are they coming from oil and gas? And then what do we need to scale from an emission reduction standpoint to address that sector individually? And we actually tie climate solutions to the sectors that are emitting. There's an organization called Climate Trace. Are you familiar with Climate Trace?
Also a past episode. So yes, big fan as well.
I should have memorized all of these past episodes. I think we're definitely on the same page. So we love Climate Trace as well. And it's a great way to just say, okay, where are these emissions coming from, right? If it's transportation, then what's going to address that? It could be electric vehicles, but it's the entire supply chain around that. And so therein lies the actual opportunity.
Very cool. I actually interviewed Gavin from Climate Trace about a year ago, so it's really exciting to hear about their progress, and just knowing that they're on the radar of folks like you really shows that they're having a commercial application exactly like they were hoping to. Heather, we've been talking a lot about mitigation and strategies for decarbonization. There's also risks that the climate transition brings to different types of companies, and that, of course, creates opportunity for investing. I'm curious, does climate risk factor into your investment decisions in any way?
Yes, definitely. We look at risk in a variety of different ways, including climate risk. And we think about it predominantly by looking at what's called the WACI. It's the weighted average carbon intensity in a portfolio. And it actually just looks at where the scope 1, 2, and 3 emissions are coming from in each of the companies, and then whether or not they're being lowered. I think a huge issue, though, with looking at the WACI and any kind of climate risk metric at this point in time, particularly when thinking about scopes 1, 2, and 3, is that they're just simply not 100% disclosed by all companies. Each company calculates them a little bit differently. Not all companies verify their carbon emissions, and some of them don't look at scope 3 either. And I'm sure you've seen everything that's gone on from a California disclosure standpoint all the way to the SEC. And it's very, I think, critical for us to continue to move forward in having companies disclose scope 1, 2, and 3 as a way to continue to measure the risk. And at the same time, I think that we're not quite there yet. We need to be thinking about that in addition to things like water usage, in addition to things like how are we polluting and whether or not that's going to be a material risk to the companies. So we definitely are looking at risk, and we do look at the WACI, but it isn't in a vacuum.
Since you brought up government, we should ask, Heather, we've got this election going on. It's weighing on us all in really countless ways. How is the upcoming election impacting your investing?
So that's a great question. It's a question on everyone's mind, and it's evolving pretty quickly. For us, the climate crisis is both a short-term and a long-term risk, and it has short and long-term opportunities. And based on all the commitments that have been made, I think it's going to happen regardless of what happens politically in the political landscape. But based on obviously who is in charge in the US and globally, it may slow us down even further. And so at the end of the day, create even more risk. So we're being cognizant, and we're not investing in companies that are fully dependent on policy or subsidies. And I think that's really important. Just thinking about whether or not a company has free cash flow, whether or not it has ROIC and what that looks like. It's super important to us to invest in high quality companies. So grid upgrades and infrastructure growth, for example, is pretty apolitical, right? Think about water, which we're doing a lot of work on, pretty apolitical. And so there are areas in climate like buildings where politicians just aren't going to be able to impact the timing of that, and they're going to continue to move forward. So it's definitely a universal issue. And I think it's just creating more noise and volatility in the short term than is necessary and isn't necessarily a reflection of the economics.
Let's break this down into short term and long term. There's the short term of now until the election is decided, right? And then there's the longer term of what's really at stake in the election. In the short term, are you holding back on some things or just waiting it out?
I would say that for us, it can sometimes actually be a buying opportunity. So if valuations are low, but companies themselves are looking attractive, then that could mean that we take a leg in and we begin to take exposure to certain names or certain sectors. On the flip side, though, areas like EV definitely could have a pullback depending on who comes into the presidency. So I think that Trump could be very focused on that, for example, and scale back the tax incentives. We're not really in a wait and see mode, but I think we're being cautious and making sure that the companies in our portfolio aren't dependent on that.
And what about the longer term and what's at stake in the election for climate?
So something that we noticed, and I think it's really important for everyone to think about, is that when Trump was in presidency, renewable energy did far better than traditional energy and far better than traditional markets. So that's a great data point, right? It doesn't necessarily matter who's the president. At the end of the day, the markets are going to do what they do. And then on the flip side, obviously Biden has been very pro climate and implemented and initiated a variety of different things that you would think would be a huge lift to renewable energy markets and climate stocks in general. And that's just not what has occurred optically. So I think that's just important to note. But if you just think about, okay, what's perceived as a Republican renewable energy? Carbon capture and storage. That's definitely a lot of the oil and gas companies that's going to continue to be pushed forward. The same thing goes for hydrogen. A lot of jobs have actually been created in the renewable energy space in Republican states. So I think it's going to be hard to roll back some of the initiatives in wind power and even in solar. I don't know if you saw recently that Texas is getting ready to surpass California actually on the solar front as well, and is already the number one state for implementing wind. So I don't think that it's going to be as dire as everyone thinks, but internationally, absolutely, I think we're going to scale back like we did initially in Trump's presidency, and there will be implications for that. That's what I think in the long term on the Trump presidency. I don't think that the IRA is going to be completely rolled back, but I do think that an axe will be taken to areas where it's possible to scale back on some of the initiatives that have been taken. And I do think that some of the agencies are going to have less power and control, like you've already seen what's happened, for example, with the EPA.
And of course, the scaling back on international commitments, which can have a rippling effect and putting an axe to at least parts of the IRA, that's all in strong contrast to what a Harris administration would bring. What do we know about Kamala's interest in climate and how much she'd likely try to accelerate climate tech?
I think we could also just talk about if Kamala wins, and I think that you could argue that she's even more pro-climate than Biden has been, and that's worth thinking about as one goes to the polls if you care about climate. So, for example, she was the highest ranking US official to attend COP28, where she really pushed the IRA. A lot of people may not know that she also organized a roundtable in Thailand to connect environmental activists with clean energy experts. And she started a partnership in the Caribbean to address climate change as well. And you can kind of go through her history as a presidential candidate, as a senator. She was actually one of the original co-sponsors of the Green New Deal. Even in San Francisco, as a DA, she actually created an environmental justice unit to address environmental crimes affecting underprivileged communities. And this was before anyone was even talking about climate justice or environmental justice. And so she's really been on the forefront of that from the beginning. So I do think, to the extent that voters care about whether or not the president is going to continue to push forward climate initiatives, that she's definitely going to support everything that Biden did and maybe even take a stronger stance. And that will definitely have implications in the investment world, in the global community. And I think it will also show the rest of the world how the United States is able to follow through on some of its stated goals and initiatives.
And it's not just the United States' goals from a governmental lens, but also corporate commitments. The ongoing backlash on ESG has sent mixed signals to companies. Many have backpedaled on their climate commitments, and as a result, many have stopped making new commitments.
Yes, I agree with that. I do still think that there are green shoots happening. And I also think that backlash is really specific to the United States. And even still, there are a lot of companies that are continuing to push forth some of their ESG policies. They're just talking about it in a different way. And so now it went from greenwashing to green hushing. So that's what you're kind of seeing, is people are changing some of their verbiage, but continuing to push through their initiatives and talking sometimes in both sides of their mouth about what it is that they're doing based on who they're actually speaking to. So I absolutely think that with Kamala in the presidency, there will be a turn in sentiment around that.
So is this discouraging to you? As an investor focusing so squarely on climate progress, is it troubling to see companies be somewhat fickle and suddenly stop talking about addressing climate as a real priority?
Okay, so I have a couple statistics that I think are really important, because it's been my experience that people are so short-term focused, particularly over the course of the last 12 months. But if you look at 2019, only 27% of the MSCI all-country world had a climate commitment. Okay, 27% of those companies. Today, it's 52%. And then similarly, if you look at the countries that had a climate target, only 33% of all countries did. And today it's at 76%. I just don't think that the rate of change is going to accelerate the way that it has historically. I also think that we're asking companies to do things that they've never done before in terms of how they're thinking about their business. So we're asking them to disclose things that they've never disclosed before. We're asking them to think about their business models in a totally different way. And we're completely restructuring our infrastructure. As a result, our supply chain, we need to be looking at that. So of course, there's going to be some resistance to that because we're trying to do it in such a fast way. But to say, oh, it's over or it's not going to happen, I think doesn't take into account the velocity of the action that's actually occurred. And I think that the media is really pushing on just a bunch of noise and confusing people. So I think it is going to continue. I think that companies are going to adjust, and it's just not going to happen as fast as we all want it to because it's hard.
Heather, thank you so much for your time today and all your insights. Wishing you and ScopeFour all the best of luck.
Thank you, Jason. I really enjoyed the conversation.
Thanks for joining us for this episode of Invested in Climate. Please remember to rate us on Apple, Spotify, or Google. Find show notes, sign up for updates, get in touch, and visualize your climate action at investedinclimate.com. This podcast is for informational and entertainment purposes only and does not constitute financial, accounting, or legal advice. Thanks again.